Hello guys, and welcome to this week's edition of the ITU FOREX class, where we're going to be talking about the power of a trading plan. Now, if you've been trading for any length of time, I'm pretty sure you know that anyone who's trading without a trading plan, especially if they're still struggling to become profitable, are basically gambling in the markets, because your trading plan is supposed to be it's supposed to serve kind of like a shield for you. Whenever you engage with the markets, it's supposed to protect you from the uncertainties of the market. So in a typical trading plan, there are going to be sections which would dictate your risk management. Okay, there's supposed to be sections which would dictate the trading strategy that you're going to be using to trade. So exactly what do you need to see before you place a buy or a sell trade in the market, and exactly what do you need to see before you close your trade with either a profit or a loss in the markets. You need all of these things to have a sound trading plan. You also need to have a section in your trading plan which would dictate how you're going to deal with the emotions which are imminent in trading. So how are you going to deal with a losing streak? Are you going to get like 4 or 5 losing trades in a row, and you're just going to dump your trading strategy and start trading recklessly? Or are you going to just wait it out, play it out, and let probabilities do their thing? Okay, so you need to have this in order to have a sound trading plan. If you don't have this, you're not going to be profitable as a trader. Now, I know it might surprise a lot of you when you hear that. In fact, most savvy traders who know what they're doing, even the first thing they would do before they engage with the markets, before they download the trading platform or fund their trading accounts to trade or do anything related with trading, is they create a trading plan. Because that trading plan is going to dictate, like I told you earlier on, exactly how much they risk per trade, how they deal with trading emotions. How do they get overconfident after a winning streak and start risking, crazy amounts of money, like half of their trading accounts capital on a single trade? Or do they get fearful in times of losing streaks and they just, cut down their risk and all of these things? If you're not trading with the trading plan, if you haven't taken the time to create a trading plan, then you're basically going to be second guessing everything you do. And trading is already hard in and of itself. So trading without a plan and just trading based on hunches or guesswork or anything like that is just going to make it doubly difficult for you. Okay, so here are the things we need to have in mind. Okay, in the risk management section of your trading plan, you need to have something in place which is going to tell you how much you're going to risk per trade. So building upon what we learned in last week's class, which is talking about risk management and all of that, you know that I told you that, in fact, even before you place your very first trade, some traders, they've already done the math in their favor, because without even placing a single trade, they already know that trading is a numbers game. So, for example, if you're trading with a 1:2 risk-reward ratio, and you've set a goal of saying you want to take 100 trades, if you're not doing any advanced risk management things, like you're not scaling out of trading positions with, when you either hit a certain loss amount or certain profit amount, you're not doing any advanced thing. You're doing just the bare minimum, the simple. When I see a winning trade, when I see a trade setup, I buy, risking 1% and aiming to make 2%. And when I see a sell trading signal, I sell, risking 1% and aiming to make 2%. It's as simple as that. If this was the type of trades you were to take, and in your in the risk management section of your trading plan, okay, you've already worked out that you're going to be risking 1% of your trading accounts per trade on every single trade you take, and your goal is to take 100 trades. Guess what? If all you did was have a win rate of 45%, meaning you only won 45 out of the 100 trades you took, then guess what? Even if you had 55 losing trades, you'd still end up being profitable. Why is this important? This is important because even before you engage with the markets, you already know that the numbers are in your favor. All you need to do is just to take a trade. So as you set a goal to take this 100 trades, as you embark on taking those 100 trades, as you engage with the markets, even if the first 10 trades you took or the first 20 trades, which is very rare in my humble opinion for the decades I've been trading, if you've engaged with the markets and your goal is to take 100 trades, so even if 10 of those trades that you take, the first 10 trades you take or the first 20 trades you take, all turned out to be losing trades, that should not deter you. That should not change anything in your mindset, because you know that it's all part of the plan. You've already worked out the numbers and you know that my goal is to take 100 trades. And at the end of taking those 100 trades, as long as I stick to the plan, meaning I risk 1% of my trading account capital on each trade I take. I think I haven't typed it here, which is, let me see if I can quickly make that edit, which is the risk per trade. Risk per trade, okay, is 1%. So the risk per trade is 1%, meaning every time I engage with the markets, every time I take a trade, whether it's a sell trade or a buy trade, I'm risking 1%. And my risk to reward ratio is 1:2. I'm going for a 1:2 risk to reward ratio, meaning anytime I risk 1%, I'm aiming to make 2% in profit. So if after taking those 100 trades, I only win 45 trades, this means that 45 of the trades I took hit a profit which is twice what I was risking on the trades initially. And the 55%, the 55 trades that I lost, because it's a 55, out of 100 trades, 55 is the 55% is 55 losing trades, okay? So if those 55 losing trades that I took all cost me a loss of 1%, then I would have lost a gross loss of, I would have had a gross loss of minus 55%. Now, after taking those trades, even though I lost more trades than I won, because I'm trading with a 1:2 risk to reward ratio, this simply means that I would have made a profit of 2% on each winning trade that I took. And since there are 45 winning trades, my gross profit would have been 90%. While my net profit, that's what I'll take home at the end of the day, would be my gross loss minus my gross profit minus my gross loss, which is minus 55%, which would be a net profit of plus 35%. Now, this is important because we haven't even talked about which trading strategy you're going to be using to trade. Some traders might say things like, I don't like trading with indicators. I'm more of a, I'm an advanced trader. Some traders like to think like that, which there's nothing bad with that. It's all you. Maybe it's the time you've invested in learning from the markets and all of that. So some traders might be like, I'm an advanced trader. I only use price action. I don't glitter my charts with indicators. Whatever works for you. And maybe that particular type of trader would be someone like, you would have seen trade setups on the charts like this. So you would have seen something like this and said, you know what? When price came here, we had resistance. And when price revisited this area again, it showed that it was finding it difficult to break above this level. So this type of trader would be somebody like, because this is basically a discretionary trading strategy that I'm giving you an example of here. So that type of trader would wait, and when he sees things like this rejection that we're having on the charts here, okay, price was rejected here. What I mean by rejected is that price in the past came here, and when he was trying to move up further, the buyers just didn't have enough strength to push prices higher. And so eventually price bounced away from this area. Now, when price revisited this area, you can see that what I said about rejection is that price tried to break above this area. Why do I say tried and tried? It's because when you look at the candles that we have here, you can see that they have wicks. These wicks are basically showing you that price pushed up trying to move higher than this area, break above this area, but it got rejected, and that's why it came back down. So it tried countless times. Tried. Price tried to break above this area, but it failed to do so. So for a support and resistance area trader, he would be like, you know what? Here, price was rejected in the past, and now that price is revisiting this area again, it's finding it difficult to break below this area. So a support and resistance trader who knows what he's doing would say something like, you know what? I'm going to risk 1% of my trading account capital on a trade. Now that I see that price has tried to break above this level and it failed, and I see this very strong bearish engulfing candlestick, immediately at the close of this candle, this trader would say something like, okay, you know what, I'm going to get into the market with a sell trade here, and my stop loss is going to be above this area, because the idea here is that behind taking this trade is that since price tried to break above this area but it failed, now I'm selling this particular currency pair, anticipating that price is going to move lower. And if for whatever reason price doesn't move lower to hit my profit target, but it then reverses and goes above this area, then the idea for this trade is already invalidated. I want to be out. I want to take my loss and I'm out. So I'm risking 1% on this trade, aiming for 1:2. So if this trader did the same thing and he was risking this 1%, aiming for a 1:2, guess what? This trade would have hit his profit target somewhere around here, because you can see his stop loss was never engaged. his profit target, on the other hand, even though price revisited this area, it still failed to break above this resistance area, meaning it held here. So this would be the trade setup that somebody who is trading with a support and resistance trading strategy, this is one of the trade setups that that person would have seen. So this would have been one of the 100 trades that he would have seen and taken a trade. But another person, another totally different person, will be like, you know what, I don't like the complications or the discretion which is imminent in trading with these support and resistance areas, or whatever the case might be. I prefer the comfort of using indicators to trade. So somebody who has this type of mindset might say something like, you know what, I want to trade with indicators. Whenever there's a price crossover, for example, whenever price crosses over these moving averages from behind, I'm going to place a buy trade at the juncture where price did that crossover. So in this case, if we had something like this trader might be like, okay, you know what, I'm going to enter a buy trade here because price crossed and closed above this moving averages here, and I'm going to place my stop loss at where the lower moving average of this band is located. So when this person would have taken this trade here, risking 1 to make 2, guess what would have happened? Immediately after he entered the market, price reversed against him and it hit his stop loss. But that doesn't mean he's not going to engage into the markets again. So let's say price crossed above these moving averages again, and he has his stop loss at the lower band. So he takes this buy trade again, risking 1 to make 2. Look at it. This time around, price would have hit his profit target. So this would have been totally separate trades that these traders would have taken with different trading strategies. But at the end of the day, their numbers would have been the same. In the trading plan, the numbers would have been something like this. All of these traders understand that. See, in trading, you cannot escape losses. Losses are part and parcel of trading. And the moment you make your mind up to accept that losses are part and parcel of trading, and you devise a plan, create a plan to accommodate those losses and to make room for them so that when you make profits, they're going to make up for the losses that you have, that's when your trading is going to start turning around. Okay? That's when your trading is going to start turning around. Now, there's one important thing I mentioned before I showed you these example trading strategies. And that's the fact that assuming when you were creating a trading plan, remember I told you that before you fund your account with $1 single to trade with, you are supposed to have created a trading plan. Now, assuming you've created your trading plan and you've come to terms with the fact that, okay, I'm going to take 100 trades and I'm trading with a 1:2 risk to reward ratio and I'm risking 1% of every of my account balance on every single trade setup I identify in the market. Assuming you've come to terms with this fact, the thing is, the distribution of the winning and losing trades that you're going to take is going to be random. What do I mean by distribution? Let me quickly show you exactly what I'm talking about here. Okay, so let me pick this text tool. So what I mean by distribution is the outcome of the trades you're going to take. So it might so happen when I write L here, L refers to loss. Okay, that's a losing trade. And then W is short for win. Okay, so just so we're on the same page. So the distribution of the trades that you're going to take are going to be random because trading is a probabilistic game. So what I mean is, when you're about to take those 100 trades, it's not impossible for you to have losing trade followed by another 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 losing trade, and then maybe a winning trade, for example. Okay, it's totally normal in trading. Or you might even have a scenario where you would have a winning trade followed by another 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 winning trade. Or you might have a situation where you have a losing trade, then a winning trade, then a losing trade, then another losing trade, okay, then a winning. It's totally random. In trading, you cannot control the distribution. What I mean by the distribution is this could be the outcome of the trades you take. Okay, so it could be a loss, then win, or loss, or loss, win, then all of these are random. So what does this have to do with anything? Well, what this has to do with important things, by the way, is that if your goal was to take 100 trades, the problem most beginning traders have is that when they already come to terms with the fact that, okay, they are going to have losses. They've made a plan to accommodate those losses. They are prepared for all of those things. But then they engage with the market, and from nowhere, they get hit by 5 or maybe 10 losing trades in a row. Guess what? They're going to start doubting their trading strategy, which is just one part of your trading plan. Remember, I told you a trading strategy is one part of a trading plan, and that part is the part where which tells you what to see before you place a buy trade in the market, what to see before you place a sell trade in the market, how much you risk on every trade that you take in the market, when to take a profit, when to take a loss, all of those things. That's just one aspect of your trading plan. But because these traders don't know any better, or because they let emotions get the best of them, when they've already done the work, they've backtested the trading strategy that they want to trade, and they've seen that that trading strategy has proven to have an edge over the market, and they've already come to terms with it. So they said, this is the trading strategy I'm going to use, and I'm going to take 100 trades with it, and all of this. But then the moment they get hit by 5 or 10 losing trades in a row, they start to doubt that trading strategy. So when the trading strategy says buy, because their last 10 losing, because their last 5 trades or their last 10 trades were all losing trades, they're going to say that, you know what, this trading strategy for the past couple of trades that I've taken, they've all been losing trades. So this particular trade that I'm taking now is also going to be losing trade. While this particular trade that they're taking now has nothing, absolutely nothing to do with the outcome of the past trades that they took. You need to understand that in trading, the outcome of one trade does not dictate the outcome of another. So just because your past trade or the last trade that you took was a winning trade doesn't mean that this particular trade that you're taking now is going to be a winning trade. They are completely independent events. Okay? So if you want to be profitable in trading, if you want to be successful in trading, when it comes time to create your trading plan, you should have it at the back of your mind that, see, just like I've worked out my numbers and saying that I'm trading with a 1:2 risk to reward ratio, and so my goal is to take 100 trades with a trading strategy that I've backtested, a trading strategy that is profitable, has proven to be profitable over time. This doesn't mean that I know that I'm not. This doesn't mean that I don't. This doesn't mean that I'm not expecting any losses in the market. It could be that just have your mindset in the frame where, even if this 55 losing trades, that's because it's 55%, that's your loss rate is 55%, your win rate is 45%. Have a state of mind where even if you were to have 55 losing trades in a row, which is next to impossible, especially if you're trading with, a trading strategy that's proven its edge over the market, you need to have your mindset in the frame where even if these 55 trades that you were to take, that's your losing trades, where all of them, they were to come in one go. Have your mindset in the frame where even if they were to come in one go, you'll be prepared to take the next trade and still not be faced by the past 55 trades which you took, which were losing trades. Because you've worked out the numbers and you know that assuming you were to take 100 trades and you lost 55 trades, as long as you just won 45 or even less than that, but it is just for this particular example that I'm using 45, okay? So as long as you just win 45% of the trades you take, which is 45 out of 100, you still end up with a net profit of 35%, which is more than enough to make some good profits if you're trading with a large account. Again, somebody who's trading $100, when you tell him that trading for 100 trades, and depending on the trading strategy that you're using, if it's a swing trading strategy, this 100 trades could take anywhere from maybe 6 months to a year, or maybe even more than that. Okay, so someone who's trading on a $100 account and you tell him that he's going to make 35% after a year of trading or 6 months of trading, is not going to find it exciting, because $35 is probably not going to pay his bills. Okay, but for somebody who is trading with, let's say, investors fund, let's say you're trading with something like $1 million, for example. Do you know what $35 is? $350,000. Now, even if that $350,000 was to be split, that profit was to be split between you and your investors, and let's say, just to make the numbers, overly realistic, let's say that out of those, that $350,000, the investors took, $250,000 because they provided the funds, and they're taking all the risk if things don't go well, and you take only $100,000 at the end of the day. Especially if you're living in a third world country, okay, not even in the, you're not living in Europe or the United States or whatever. or the Americas, $100,000, especially in Africa, is enough to change your life completely. If you're making $100,000 per year, consistently, that is enough to change your life. So I want you guys to really stop thinking about, 35% is too small or 10% is too small or all of that. You need to start thinking, I need to improve my skills, because if I improve my skills well, then eventually I'm going to have something that would help me to build a track record, which I'm going to have and which I'm going to use to lure investors in, to convince investors to invest with me so that I can trade for them, and we split the profits. But even if investors were to come to you today and offer you not $1 million but $10 million to trade with, but you don't have that skills, you don't have the skills to trade profitably, you don't have the risk management skills, the psychomotor skills, the psychological skills, or the technical skills to navigate the markets, you don't have any of those skills, guess what? You're still going to blow the account. You're still going to blow the account. It might take 1 year, or it might take 6 months, or it might take whatever. But eventually, if you don't have the skills, you're going to end up blowing the account. While on the other hand, even if the investors that you're trading with, they just provided you, let's just say, not even millions, just $100,000, which you can easily get with prop firms or whatever. In that case, even if the capital was smaller like that, you'd still be able to make some good amount of profits as long as you have the skills. So stop thinking about this profit amount is too small or it's too little. Forget about trading $100 accounts for a minute and focus on improving your skills, learning the skills, especially with this ITU Forex classes which we deliver, because every single week we try to do the best we can, give you tips, tricks, and tricks, tips that are going to help, techniques that are going to help you to improve your manual trading skills. So if you're watching these classes, you're doing your research, you're doing the backtest, you're doing all of the things that these professionals do, eventually at the end of the day, you'd have skills which are marketable, which would be good enough for you to make profits with, for you to navigate the markets and make a killing with it. But as long as you're having that mindset of, I'm only trading $100 account and I just want to flip it, I want to flip it, guess what? You haven't even taken the steps to become a profitable trader. Do you think the big traders around the world, the ones who've made names for themselves, the George Soros and the investors like Warren Buffett and all of that, do you think they're flipping $100 accounts? Of course they are not, okay? So focus on learning the skills. And like I told you earlier on, risk management is just one part of your trading plan. You have the psychological part, and you also have the trading strategy part. The reason why I don't have them written here like I have with the risk management part is because your trading strategy is going to depend on you. Let me tell you something. You see this 100 trades that I'm showing you as an example. Some trader out there who really understand that trading is a game of probabilities will not even need any single trading strategy. He might do something as simple as flipping a coin, so that if it lands on heads, he's going to buy, and if it lands on tails, he's going to sell, and then still end up making profits. Because that trader understands that risk management, every time he's placing that trade that he's about to take, he's risking 1% of his account capital, and for all of those trades that he's risking 1%, he has a risk to reward ratio of 1:2. So at the end of the day, it doesn't matter whether he's just flipping a coin or he's doing what. Even if he were to lose more trades than he win, because risk management has been capped, his risk has been capped at 1% per trade, and he's aiming for a risk to reward ratio of 1:2 or even higher or whatever. Even if his win rate was only 40%, he'll still end up making profit. Maybe not as much as 35%, but still he would end up making profit. Now, what does this have to do with anything? If somebody who is just doing a simple coin flip, he's not doing any technical analysis, or he's not looking at support or resistance or indicators, or he's not doing any of that. He's just flipping a coin, and if the coin lands on heads, he buys. If the coin lands on tail, he sells. The only thing he does different from most of the losing majority of traders is that he caps his risk. So whenever he's about to engage with the market, place a trade, he knows that risk management is very, very important. It's not like a trading strategy Because a trading strategy, you can use any trading strategy that you want, which brings us back to the example I'm giving you here. He knows that risk management is more important than the trading strategy, and so whenever he's placing a trade, his cap, the maximum he's risking on that trade is 1% of his account capital, and whenever his exit plan is that if the trade doesn't move in his favor, he will only lose 1%. But if the trade moves in his favor, he's going to make a profit of 2%. He knows that this risk management is so important that he incorporates this into how he's trading, even though it's just flipping a coin. At the end of the day, even if he was to lose 60 trades or 70 trades and only win 30 or 35, he would still end up with more profits, because his winning trade, his average winning trade, is much larger than his average losing trade. So your trading strategy, it depends on you. Find something that you resonate with. Are you somebody who likes support and resistance? We've talked about support and resistance a couple of weeks back. Now, go and watch those videos. Watch a couple of other videos again to improve your support and resistance trading skills so that you become a very, very good support and resistance trader. But what if you don't like trading with price action? You prefer using indicators. Again, there are lots of strategies out there. Find one that works for you, that is convenient for you, that fits like a glove for you, and then backtest it. And if you've proven that that trading strategy has an edge over the market, create your plan. The strategy is going to cover, it's going to cover the portion of your trading plan, which is going to dictate when you buy, when you sell, how much you're going to be risking, when you take a profit, when you take a loss, all of those things. While your risk management plan is going to be something like this. And psychology, the reason why I'm bringing psychology for the last is because it's the most important. You see, most people think that psychology is not important in trading, especially beginners. Let me tell you something. Psychology is even more important than risk management and your trading strategy. Why? Because you could have a goal of taking 100 trades here, but like I told you earlier on, if the first trade you took was a losing trade, second trade, losing trade, third trade, let's say all the way to the 10th trade that you take, it is trading psychology, having your trading psychology on point, that is going to save you and help you to keep taking trade upon trade upon trade, even if they keep turning out to be losing trades. If you don't have the right psychology, you're going to start doubting your trading strategy. So your psychology now, because you don't have it on point, is going to affect your risk management. It's going to affect your trading strategy because you're not going to be following your trading strategy's rules. It's going to affect every other thing. But if you have your psychology on point, even if you were to lose all of the 100 trades you take, it's not going to bother you because you know that, it's just a numbers game. As long as I practice proper risk management and I follow a trading strategy that has an edge over the market, even if I was to lose all of the trades I set a goal to take, at least I'm following the rules that I'm supposed to. So your trading psychology is because if you have a couple of losing trades in a row, those who don't have their trading psychology on point are going to now start saying, you know what, I lost 10 losing trades in a row now. So instead of risking 1%, I'm going to cut down my risk per trade to 0.5%. And it's not because they backtested it and proven that it works. So no, it's simply because they had losing trades and now they don't want to lose another trade. Guess what? Let's say you cut down your risk per trade to 0.5%. And the next 5 trades you take all end up being winning trade. Now, in this case, let me show you what the outcome will be. Okay? So let's say here, you took 10 trades, and all of them ended up being losing trades. And because you were risking 1% per trade, so those 10 losing trades will be a gross loss of minus 10%. But let's say the next trades you take, okay, they all end up being winning trades. Now, if you were risking 1% per trade, and you were aiming to make a profit of 2%, okay, on each winning trade, if you continued risking 1%, that would be 2% times, okay, that would be 2% times how much? Times the 5 trades that you took, which will give you a profit of 10%. So you lost 10 trades and you are down minus 10%. But the next 5 trades that you took, if you are risking 1%, aiming to make 2%, that's 1:2 risk to reward ratio. At the end of the day, those 5 winning trades that you had would have made back all of the money that you lost. Okay? But if, for example, because your psychology is not on point, and so instead of risking 1%, you cut down your risk, not because your trading plan tells you to do so, just because you're just scared of losing money. You cut down your risk to 0.5%. Guess what? Each one of those winning trades would have only brought in a profit of 0.5 times 2, which is 1%. So at the end of the day, those 5 winning trades would only bring you a profit of plus 5%. Now, because you got scared, because you let it affects your psychology. Now you've cut down your risk per trade, and guess what happened? Eventually, instead of recovering the money that you lost with those 10 losing trades, you only made 5%. You barely scratched the surface with a good winning streak here to cover your losses because your psychology was not on point. So basically, you want to trade in a state where when you lose 10 trades, it's not going to affect you negatively to start cutting down your risk per trade or start ignoring the trade signals of your trading strategy or start doing anything like that. And when you win 10 trades, it's not going to get to your head, and so you start risking more than 1%, or if your trading plan doesn't tell you to do that, because you feel invincible in the markets. That's basically what psychology is, okay? So once you understand this, you have done most of the work, because you're just if your goal is to take 100 trades, whether those 55 trades that you're ready to take as a losing trade, they all come in one go, it's not going to bother you, because you understand that it shouldn't affect your psychology. You should just create a plan, go with the plan. Simple. Okay, so this pretty much brings us to this week's the end of this week's edition of the ITU Forex class, where we've talked about having the power of having a trading plan, even without notice what we talked about in the class today. Your trading strategy could be different. In fact, somebody could even flip a coin to know when to buy or when to sell. There's no technical analysis whatsoever involved here. But if your risk management and your trading strategy, your risk management and your trading psychology are on point, you'd still end up being profitable. Okay, so this shows you clearly how important having a trading plan is and why you need to have one. And this segues into the end of the class where we talk about the ITU suite of bots. The reason is because, you see, these strategies and techniques and tips and all of these things that we talk about in the ITU Forex classes are meant to help you improve your manual trading skills, okay? And to also help you understand exactly the intricacies of trading in the Forex markets and what you need to be successful and all of that. But there are also easier ways to trade, which is using a bot like the ITU suite of bots, which is going to help you do all of this on its own. It's going to help you do the risk management, the lot size calculations, everything. If you follow our recommendations on how to set it up step by step, it's going to help you do all of that. So if you're interested in earning while you're learning, then please reach out to the ITU support team or anyone on our socials, and we'll be glad to help you set up everything and start taking advantage of the markets. Okay. So again, just to reiterate, this is not a get rich quick scheme, or the bots are not just going to you just fund your account with $100 and you wake up next tomorrow and you're a trillionaire or whatever. No, that's not what it is. But if you're interested in having something that is reliable, that is it's going to take losses, but it's also going to make profits. But it's going to do all of the risk management for you by itself, especially if you follow our low risk recommendations. Okay, so if you're interested, please reach out to us on the socials, and we'll be glad to help you out, set everything up, and voila, that's it. So once again, thank you for this, attending the class, making your time out of your busy schedules to come. I look forward to seeing you guys in next week's edition. Have a wonderful day, and God bless you all. Thank you.